Welcome to the Friends with Money podcast, brought to you by Money Magazine, creating financial freedom for Australians since 1999.
Welcome to Friends with Money. I'm your host, Michelle Baltazar, Editor-in-Chief of Money Magazine. Thanks for joining us. The market whiplash in the last 2 months due to Trump's on-again, off-again tariffs since April has unnerved many share market investors, and it reinforced the value of diversification, particularly across fixed income. In today's episode, we're going to talk about one type of fixed income called global private credit. And joining us is Nehemiah Richardson, Chief Executive and Managing Director at Pengana. Nehemiah, thanks for joining us.
Yes, thank you for having me, Michelle. Pleasure to be here today.
So let's get to the first and fundamental question. What is global private credit?
So when we refer to global private credit, we are talking about the US and European markets. Okay, so we're not talking about Australia we're talking about US and Europe. Okay, I think which is critical. And that's because in those markets, this is a very large, mature market that's been growing very quickly, been around for 25 years with many managers who have proven track records of success in it. So what is it? It is lending to companies predominantly. And it's where banks have exited lending in these spaces. So about 85% of a lot of these corporate segments that our managers invest in provide 85% of lending to those segments is done by private credit managers, so professional credit managers, and 15% by banks. And that continues to grow. So, and it provides really attractive investment characteristics to investors off the back of lending to very defensive, non-cyclical companies in those jurisdictions.
So investors understand the kind of rates they would get from term deposits, for example, or from banks where it's the savings rate of anywhere between 2 and 4%. So why should they look at global private credit? What would be the interest rate profile?
Yes. So what you'll find is that there's a few things that are important there. Number one is it's contractual income and it's floating rate. So it's a fixed spread over the cash rate. Okay. And so moves with interest rates. So what's really nice about that is in inflationary environments where the cash rate goes up, you're actually protected because it's a fixed percentage above a cash rate. Right. So for example, we have a 1-year term account, which is part of one of our products that offers 3% over the RBA cash rate. We have other products that offer different types of spreads, but that's really a consequence of fund managers who will make a loan to a company and they will hold it until it's paid back in full. And as a result of that, you tend to get, they call it an illiquidity premium, but you tend to get anywhere between sort of 1% to 2% sort of premium for the fact that they're holding them to maturity. They are not trading them out in the market and getting a fee for that. They actually want to get paid back. And as a result, you have this, what they call illiquidity premium attached to it. And that's why the interest rates are really attractive relative to the risk that is taken on any individual loan.
You mentioned earlier that you are not a bank, and I think this is important for investors who have invested in, say, a savings account or a fixed term deposit that is guaranteed by the government. So that's up to $250,000 with a bank is guaranteed by the government in case of something happening to the market, for example. So how can people or investors be protected when they invest in something that is not provided by a bank?
Yes. So there's a number of different things that allow you to mitigate the risk, okay, in this. So number one, it comes down to the manager and how they invest. So how selective are they? So your top managers in this space in the US and Europe, very selective about who they lend the money to, okay? And that's why it's to defensive industries, non-cyclical industries, kind of boring cash flows, healthcare, business services, software, very stable industries with market-leading companies. Number two, senior secured. So what that means is you're investing at the top of the capital structure at a low loan-to-value ratio, typically between 30 and 50%. You have priority of income payment. you have security to get paid back, and you have priority of getting paid back before anybody else does should the company run into trouble. Number 3, widely diversified portfolios. Okay, so any one loan. So for example, our portfolio that we invest in has over 2,000 individual loans across 20 managers, because we're trying to eliminate any idiosyncratic risk, any single name risk, single manager risk, single loan risk, so that if one was to underperform or one loan was to go into loss, it would have no real impact on the overall return in the portfolio. So it's those types of disciplines that actually help to support the credit profile. And that's really, kind of different layers of defense, if you will, for investors to feel comfortable investing in the asset class.
Definitely no junk bonds.
No.
That's good. So I think a lot of our listeners understand local private credit, where we're talking about companies that they're familiar with, whether it's corporate credit through a top 200 company, or it's just understanding how businesses work and they need to borrow money, either from a bank or a non-bank. But tell me why it's important for investors to consider not just local private credit, which they know, but global private credit, where arguably we don't really understand how businesses work overseas.
Yeah, so a couple of things there. So firstly, just to touch on Aussie private credit, if you look at the structure of our market, about 90% of all lending is done by banks. 10% is done by private credit. Okay, and so it's actually quite a small subset of the overall lending market, which is why it's really concentrated predominantly in commercial property, but also in subordinated positions in asset-backed vehicles, and you'll see it in kind of widely syndicated loans for big PE deals. That's where it's really concentrated. There's a tail, but that's predominantly what you get. And if you look overseas, what you'll find is it's sort of the exact opposite. So you have big sections of the market, so companies that are sort of a billion plus in size, that really aren't serviced by the banks anymore. 85% of that market is banked by private credit providers, and the balance by banks. And they used to be companies that were on the bank balance sheet. But since the GFC, because of regulatory changes in the US and Europe, right, banks don't have an incentive to lend to them anymore. Okay, because in the European and US markets that were really hit hard by the GFC, the regulators really don't want banks holding long-term assets funded by short-term deposits. So it's about the liquidity mismatch. And so as a result, you have a lot of these great companies, great market positions. Banks would love to lend to them, but they have to hold too much capital against them. So the returns aren't as attractive as where else they could deploy their capital. As a result, you have private credit providers who raise institutional funds, and now increasingly, funds from retail investors that are used as the funds that are then lent to these companies. So it's interesting, because if you go to those markets, the US and Europe, it's much more widely known and much more widely understood.
Yes.
And the analogy I like to use here is, I remember, say if you look back 25 years ago here in equity portfolios, it was domestic equities. And broadly speaking, people wouldn't do global equities.
No, not at all. We were all about our dividend generating shares. Yes.
Precisely, right? Now, how many portfolios today, and if you have someone professionally constructing your portfolio or an advisor managing your portfolio, would tell you it should all be in domestic equities and not in global equities. Wouldn't happen. And I'd say the same thing, the industry in the US and Europe's been around over 20 years. It's much more accepted and understood because the opportunity has been available. It's now become available here. And I feel like it'll end up, you fast forward 5 years' time, you'll end up in the same position that we did with equities. It'll be a staple as part of a broad portfolio. It'll be a staple allocation because of these attractive characteristics.
I'll tell you what, we will have this interview again in 2030, and we'll see what the split is. But you are quite right. I remember covering Aussie shares versus global shares allocation 2 decades ago, and it was like, no, we don't want any of the global shares. We're happy with local shares. But I just want to point out again that the statistic from the IMF that global private credit assets under management have quadrupled over the past decade to US 2.1 trillion. So what are the latest innovations in this space?
Yes, so I think the single biggest innovation, I would say, is retail investors getting access to what has been an asset class that only institutional investors could access, like the future fund or industry super funds. And that's just because there's been some significant barriers or obstacles for retail investors to be able to access it. And I think people like us, like the Pengana Credit Group, have overcome a lot of those obstacles to make it very easy for a retail investor to get access to top-rated managers on a highly diversified basis.
So let's say one of our listeners is saying, I'm close to retirement. I'm now thinking of shifting some of my investments in shares to now more fixed income or something that provides a steady income. I know that Pengana partnered with Mercer to create this product called TermPlus.
Yes.
So how would you describe that? Like, what is the minimum investment? And what are the three key features of TermPlus? Bearing in mind that a lot of our listeners are probably thinking, TermPlus, is that a term deposit?
So the first, and very important to say, we are not a bank, okay? But what we've done is, like I said earlier about global private credit is professional managers who provide lending to defensive companies on a secured basis. Okay, so basically what you have is we've built 1, 2, and 5-year term products. So by way of example, a 1-year product is RBA, so it's a fixed percentage above the RBA cash rate. So our 1-year product, for example, is RBA plus 3%.
Mm-hmm.
So as the RBA price moves, we will pay 3% over the RBA rate, okay? And where that really comes from is when you invest in our funds, what we do is we invest in our portfolio. Our portfolio has 21 managers across the US and highly diversified. So 21 funds across the US and Europe, over 2,000 individual loans. So there's no concentration. There's not one single loan will make a difference to the overall portfolio. And it's as diverse as possible to kind of minimize any type of concentration risk. So that $1 sort of gets split across 2,000 plus loans,
Mm-hmm.
provides you with stable monthly income that's annualized RBA plus 3%, for example, on our 1-year product. The other things that we've done is we invest, for every dollar we get from an investor, we invest 5 cents of our own capital. Okay. And what that is there for is really to do two things. It's really to help to support the income payments. And it's also there to support repayment of capital. So very simplistically, we do not get paid income on our capital until every one of our investors across our term accounts gets paid. Okay. And so it's always that the investor gets paid first. And then at maturity, if for whatever reason there was an impairment in the fund that meant you couldn't get your capital back, we basically will use our capital to support, to ensure that we can provide, some capital support to getting that dollar back for you.
Mm-hmm.
Okay, so it's really building in some additional protections over and above the protections that come from the way that our managers invest, the wide diversification in the portfolio, the security that sits behind all of these loans. Okay, so we feel really proud of having introduced that innovation into the product to really make this accessible at a minimum $2,000 investment and a very sort of defensive investment.
Which I think is quite relevant and timely right now, where geopolitics is truly doing a recalibration or reset of the markets, and how do we value shares, and is it going to be a recession or not a recession, and all of that. There's definitely a lot to unpack there, but as I mentioned earlier, this is a $2.1 trillion asset class, so it's quite hard to ignore it, and it's set to just keep growing bigger. Nehemiah, any other words of advice to our listeners?
Yes, I think, number one, it's a must for investors to look at this asset class. Okay, and the reason being, whilst you have lots of different investments you can do in Australia, this is a very mature It's been around a very long time, mature, diversified asset class, done very professionally with long track records of performance, number one. Number two, in an environment where geopolitically, from a risk volatility perspective in equity markets and traded credit markets, I think the need for defensive income-oriented assets is critical, that do not trade, that are very well managed, and provide stability of return, particularly when you think about the demographic challenges that we face with aging population as you go into retirement. It is a must. For that reason, it's a must look. And there's many resources that you can find online to learn more about the asset class, which I strongly encourage people to look at, because you will find that there are many managers who have these long track records of success. They wouldn't have the brand names that you might see in the big end of town because they haven't been prominent. They've just been doing what they've been doing for a long period of time. And now the results that they deliver for investors are coming to light. And I think that's why you see much more press around it, but it is not new. Okay. It is lending to companies. It's been around for a long time, and the industry itself has been around for a long time. It's just, you haven't seen it in Australia. And I think it's really important for people to look at as a point of diversification.
Fantastic. Nehemiah, thank you so much for your time.
Yes, it's a pleasure. Thank you.
Thank you for listening to this episode. Until next, I'm Michelle Baltazar. Bye for now.
Thanks for listening to the Friends with Money podcast. For credible, independent, and easy to understand financial commentary, visit moneymag.com.au. Please remember that the views and opinions expressed in this podcast are general in nature, and further independent advice and research based on your personal circumstances should be sought before making an investment decision.